anti-avoidance rules, a quick recap. So the first thing is you need to think about, well, does a specific anti-avoidance rule apply? The one I come across most is Section 817, which is the provision where it tries to counter schemes that convert income into capital by converting them back into income. So if revenue have a specific provision they can apply to you, they will always use that. They only go to Section 811C, the general anti-avoidance, where they don't have a specific provision that they can use. So what if you're talking to a client on a transaction that's a little bit edgy, that's the first thing you need to decide. Then you need to stand back and say, okay, well, is this a transaction that gives rise to a tax advantage and wouldn't have been undertaken except for the tax advantage? And that requires a bit of thought and consideration. And then if you sort of come to the view that, in fact, you are within a specific anti-avoidance provision or within the general anti-avoidance, you then need to start talking to clients about your mandatory disclosure regime, whether you need to mandatory disclose, and we'll go through that in a few minutes. And then you need to explain to clients, look, you can implement a transaction, but if you lose, you end up paying the tax, you end up paying the interest, and there's the nasty tax avoidance surcharge of 30%, plus you could have legal costs. Then you go on to the client and say, yeah, but the surcharge and the interest, it does vary depending on whether it's a mandatory disclosure and whether you've made a protective notification and whether you've made a qualifying avoidance disclosure. Another point to say to the client is, don't assume that after 4 years you're fine. If revenue formed the view that general anti-avoidance applies, well, that there's no time limit.